Hello, listeners. Welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and director of geopolitical analysis at Cognitive Investments. Joining me for our weekly chat is Rob Larity, our chief investment officer. We spend just the first 10 minutes of the podcast talking about what's going on in markets this week, everything from the Federal Reserve to are we in a recession? What does that mean before really digging in for an hour-long conversation about China and the real estate crisis there and what we think about that. As Rob says in the podcast, it is one of the most important things that is happening in the world right now that nobody is talking about, and that's why we spent so much time talking about it and around it and trying to figure it out. So we hope you enjoy this episode. Otherwise, please leave a rating or review if you haven't already. You can always write to me at jacob@cognitive.investments if you have any questions, insights, comments, concerns, or want to learn more about Cognitive Investments. Also, just an apology. My Italian geopolitical friend was unable to come onto the podcast and talk to us about Italy's political crisis, but if you want to know our view on it, I did the Global Sit Rep on it last week, and if you haven't signed up for the Global Sit Rep, now is a good time to do so. So, enough from me. Cheers. See you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Good morning, Rob. Apparently, dealing with markets and geopolitics is literally turning your hair gray, but it's nice to see you again.
Well, it happens to the best of us. Nice to see you too.
I've noticed that the light in my office, the listeners can't see this, but we can see each other on the video. I've noticed that the way the light comes in the morning when I'm doing these videos, it looks like I'm a replicant, like that thing in Blade Runner. You can see the light behind my eyes. It's kind of, I don't know why I'm telling you guys that. I like sharing my thoughts. So let's dive straight in. As always, it's been kind of a topsy-turvy week in terms of markets and news. And then you and I want to spend the bulk of this podcast talking about China. And we probably won't get through all of China. We should probably just consider this the opening salvo in a much longer conversation about China. But, there's a lot of news this week. Why don't we start with the Fed? The Fed hiking rates 75 basis points. The market seemed to like that. Jerome Powell said we weren't in recession. Then the next day, the Commerce Department said, no, actually, GDP contracted for a second consecutive quarter, so we are in recession. But, a lot of indicators don't seem to be matching up with each other in the way that we might think. So why don't you just take us through kind of your perspective on the news this week and how it fits or doesn't fit with kind of the thesis we've been laying out the past couple weeks being more bullish than most of the rest of the herd?
Sure. And just as a preview of the China discussion too, we often point out here things that we've gotten right, or, we said that this would happen and it did. And just in anticipation, I think the China discussion is going to be something where we've been pretty bullish on China, pretty optimistic. And now we're really considering whether we're wrong and whether we need to reevaluate that. So, in the spirit of always being objective and changing our minds easily, that's the preview of what's to come. Elsewhere in the markets, so the U.S. markets are still rallying. We've been talking about this for a while, how bad news is good. And the way that this is being expressed is as growth is slowing down, as you mentioned, we're now officially in a recession. It doesn't really mean anything, but optically, it means something. The expectations for interest rate hikes have really come off the boil. So you can see short-term bonds have come in pretty dramatically in terms of yields. Long-term bonds have come in. The entire yield curve is now below 3%, which is a big change from where it had been. And markets continue to like this. So like we talked about last week with D.R. Horton as an example. That's a company that put up terrible numbers and the stock is up. So paradoxically, the market is looking at what's going to happen 9, 12 months down the line. They're incorporating a slower inflation scenario, lower interest rates, and they're less scared than they were before. So this is a very positive development. You're seeing rotation into some of the kind of stronger companies that had been whacked mostly on multiple compression. So their valuations went down, even though their results weren't that bad. The areas of the market that are still lagging are the areas that are tied to lower end consumers. So if you look, Aaron's is a good example. Aaron's is a retailer, a rent-to-own retailer, and they came out and said that they're having significant credit problems with American consumers who are lower income people who shop there, and that stock has been hit really hard. Rent-A-Center, lenders that focus on subprime and lower end consumers. But aside from that segment of the market, most of the US consumer base looks fairly healthy, and we're working off the inventories in the system, which we've talked about, not only in the consumer area, but also in tech. So a lot of the semiconductor companies have come out and pointed out that the tech ecosystem needs to run down its inventories of semiconductors now because demand for electronics, computers, PCs, mobile has slowed. So you have this inventory effect that has really weighed on growth, and the residential investment effect, less investment in housing, less investment in durable goods, because we had such a boom earlier and mortgages have gone up. Those are the two big drags on the economy, but everything else is looking fairly steady. So that's the US. If you go to Europe, Germany put out its latest industrial growth numbers, and they were horrible last week, or earlier this week, I should say. And that's pretty well expected. The thing that is less commented on is, again, if you look at places like Italy, if you look at places like France, the industrial confidence indices. So these are surveys of business people saying, what do you expect, for the 12 months ahead? They remain remarkably good, remarkably strong, like back still above 2017 levels, which was a very good time for the EU. So a lot of Europe is still looking very durable, and European stocks and asset prices are holding in, even as European bond yields come down a lot, because they're anticipating, excuse me, a slowdown in inflation, a German slowdown. So Europe is holding in, and there's more and more evidence that this travel boom and tourism boom continues to support. And Hilton reported yesterday, and the CEO of Hilton actually called this out and said that European demand for travel is off the charts still. So they don't see any slowdown there, and that's been a big driver. So that's Europe. And then elsewhere in the world, places like Brazil and Chile, after selling off earlier this year on the Chinese slowdown, and the emerging market slowdown and the dollar strength, those have really rallied strongly in the last few weeks as the dollar has weakened and as expectations on Chinese growth and Chinese stimulus become a little more optimistic than they were. And obviously, we're going to talk about China. But that's the tour of the world.
We're recording here on Thursday morning. This will come out Friday morning. Right before we came on here, it was reported that the U.S. and the Democrats actually agreed to a compromise on their climate social spending bill. A pretty big U-turn, because it seemed last week like Joe Manchin was just saying, nope, not going to happen, and that the Democrats were going to have to let it go. They're not going to call it Build Back Better. They're going to call it the Inflation Reduction Act, which is a little funny because even though there is reportedly there's 300 billion in deficit reduction there. And I apologies, listeners, I thought I might skim it before we got on here. It's 725 pages long, so I had to go to articles that summarized it. I'll have to read it this weekend when I'm having trouble sleeping. But it includes 300 billion in deficit reduction via a new 15% corporate minimum tax. But then it also includes 370 billion of spending on climate and energy reforms, 65 billion to shore up healthcare, some more billions of spending on clean energy and tax credits and things like that. So I always loved math, but was not the best at it. But that sounds to me like they're actually spending more than they're cutting, and it's the Inflation Reduction Act. So does that move you at all, Rob? Do you think that moves markets at all? Or do you think they just don't really care about what's going on in Washington and that they predicted maybe something would come through eventually in a compromise deal?
Honestly, I don't think it's such a huge deal, except for the industries that are directly involved and that might benefit from stimulus or subsidies for EVs and things like that. I don't think markets are that focused on it. I think there's an assumption that the days of huge fiscal stimulus are over, unless there's some major catastrophe that we don't anticipate. I think people were surprised by this, as in markets as elsewhere, but I'm not sure that it's any sort of game changer.
Yeah, and speaking of surprise, there's a quote here on Twitter from the Senator Tina Smith from Minnesota. "Holy shit, stunned, but in a good way." So apparently a lot of people are stunned by it. Specifically on energy, do you think it matters at all? I mean, I guess it supports solar or wind or some of these other industries that have been looking for this kind of help for a long time, an extension of tax credits. Does it have any follow-on impact in your mind for oil, natural gas, either in the short term or long term, or just kind of doesn't really matter? The market is going to do what it's going to do on that. I noticed, I asked that too, because I don't know if you saw this, but Asian natural gas prices rocketed up in the middle of this week as the Asians and the Europeans seem to be competing now for a limited amount of natural gas supply available on the market going into winter.
Yeah. Like yourself, I haven't had a moment to read the 764-page bill yet. I was reading a 164-page report on Chinese shadow banking. So there's only my limit is 1,000 pages per day.
I think there should be a rule or something that you have to have less than is it $1 billion a page at this point in the package? Anyway, let's turn away from that and get into the real meaty stuff with China. We'll probably keep this podcast to about an hour. I'm not even going to pretend like we're going to get to all of the facets of what's going on in China here. Maybe I'll just start with, from a geopolitical level, why we've been bullish on China, and you can talk about, from a market perspective, why we've been bullish on China, and then we can back into what's been happening and why we're concerned. Geopolitically, I would just say that, from my perspective, people have been very down on China, especially in the West, for a long time now. It all goes back to the beginning of the U.S.-China trade war in the Trump administration. And there is just this narrative drumbeat about China being an authoritarian, genocidal, dictatorial regime that is terrible and it's uninvestable, and they're all getting old and going to die soon, and the Three Gorges Dam is going to collapse, and the entire economy is a Ponzi scheme. You've been hearing this kind of over and over and over again. The flip side of that, though, to me, is that China's an up-and-coming nation. It has reached a certain level of growth, and geopolitically, it has to keep growing or it's going to fall apart. And I don't think the Chinese Communist Party wants to fall apart. So my sort of geopolitical take on this has been, this is going to be a rough decade for China, but we should see the Chinese Communist Party try and make some difficult decisions to make the economy healthier. And also, we should see a lot of support in industries that should be productive. We should see China move up the value chain. We should see it become a semiconductor giant. We should see it become a leader in technology that it hasn't been thus far. And those are things that are all positive from my perspective. I think when you got to the end of the decade, I was a little more doubtful, because then the demographics start coming into play, and then we're talking about more direct competition rather than, yes, it's competitive right now, but it's nothing like it's going to be if we stay on this trajectory. So that was kind of and the last thing I should say is, I think people were freaking out about Chinese regulatory moves to crack down on tech or to crack down on real estate developers, which is the one that we'll talk about a little bit later. I always saw that as a net positive, because part of the problem with China for the past 20 years has been it's the wild, wild east, I guess I should say. I mean, there were rules, but nobody followed the rules, and there was a lot of corruption, and there was a lot of local governments doing shady things that maybe people didn't know about. And it's not necessarily a bad thing if China wants to enforce regulations. Regulations mean stability, stability means predictability, and then investors, whether you're a company who wants to relocate to China or you're an investor who wants to invest in something in China, you want predictability. That's exactly what you want. So I never understood the narrative around that. So for all those reasons, I was feeling more optimistic about China than most of what I was seeing out there. Do you have anything you want to add from sort of a more financial or markets perspective about why we were feeling bullish about it the last 2 years is when we've really been focused on it?
Yeah, well, I think we started to get involved after, a lot of the drumbeat of negativity had really reached a crescendo around the intervention and sort of this narrative that, they were crushing markets and crushing free enterprise, and they were going to squash the big tech companies. And a lot of these companies were down 50, 60, 70%, which at that point they began to look very attractive from a valuation standpoint, just relative to what their realistic prospects were, even in a less wild, easty scenario. So we started, putting on exposure for our clients in China. We bought specific positions in Tencent in our focused equity strategy. And that was basically our thinking was, valuations looked attractive. You had markets that appeared to be trying to put in a bottom after, suffering. And earlier this year, that really started to look like it was playing out. So if you look at the Chinese equity index or some of the larger tech names, they have been leading the market out of this trough. So we've talked a lot about the US rebounding and how we were becoming more bullish. China has been leading the way, and they were there first, and they were there bigger. And now they're sort of, giving up some of that initial burst. And we find ourselves in the position of evaluating whether we should get out or whether, we should maintain that original thesis. So that's the story so far.
Or double down, I guess, is another potential option if we felt good about it, right? Because we've enjoyed the wave kind of upward, but now it's treading water a bit. In terms of what's happened, so it also, I guess the canary in the coal mine is Evergrande, and Evergrande is not really what concerns us. But for listeners that don't know, Evergrande is at one point I think it was the most valuable real estate company in the world. It was the second largest property developer in China, and around August, September 2021, they started having liquidity problems. And by the end of last November, they actually started defaulting on debt. And this, in part, was a result of China and the Chinese Communist Party and Xi Jinping in particular cracking down on property developers. So in 2017, 2018, Xi really started pumping the brakes on credit in China, and he didn't want the property market to keep booming. A lot of Chinese companies listened. The property developers didn't. And we can talk about maybe why they didn't and why real estate is so important to China. But the important sort of thing is that after they didn't, the Chinese government basically started telegraphing, hey, we're not just going to bail out these property developers. They have to learn a lesson here that if they're going to engage in irresponsible lending and empty growth calories, that the Chinese government is not always going to be the backstop. And that was a big shock to the market. I think the market was expecting that China was always going to go to the rescue. That's fine. That was part of our bullish thesis. We would expect China to do that because that means we're getting a more productive economy where debt on a balance sheet actually means something, and it's not just something that can be swept under a rug by an asset management company, which is what China used to do in the past. The problem, though, is that in the last, couple weeks, in the last month or so, you've been getting individuals who don't want to pay their mortgages, and you've been getting protests outside of banks because they were sold wealth management products and they want their money back, and they're not getting their money back. And you couple that also with the sharpest decline in Chinese real estate prices since 2014 or 2012. Those were two other moments when Chinese real estate prices started to go down. But you've got some months of data now where not only are the property developers in trouble, it seems like real estate values are also going down. And this is where the importance of Chinese real estate in the Chinese economy is important. I mean, just to throw some stats at the listeners, 65% of private household assets in China, this is 2018 data, but I assume it's similar today. 65% of private household assets in China are in some form of real estate. That's compared to 49% here in the United States. Basically, the way that Chinese people put wealth away is they buy property. 87% of urban households own their homes in China. Another 20% own multiple homes. And I mean, one of the other real stats that kind of blew my mind was that the value of the real estate industry in China tripled basically from like the late 90s just to 2006, and it's been doubling and tripling ever since. So that was kind of the problem. And Rob, you were actually the one who said to me that you didn't like this. So tell me, in that mishmash of things that I identified, what was the moment where you stopped and said we need to look at this a little bit closer?
I think it's helpful to step back and look at the last 10 years in a sort of timeline to answer that question.
Mm-hmm.
I think it was in 2010 that Jim Chanos famously said that China is on a treadmill to hell. And, that was when the peak of worrying about China was taking place. And people were taking videos of the ghost cities, and, these exposés were all hitting the news wires, and there was a lot of concern. And Jim Chanos was right. The problem is that the treadmill can keep going for much longer than people often expect.
Mm-hmm.
And that was 12 years ago now. That's a lifetime in financial markets. The background to this is that China's economy, I guess, it's difficult to overstate how big this problem is. And part of our sort of sleepiness about this is that we've been living with this for so long, we've just assumed that this is how it is. But when you look at the scale of malinvestment in China, the scale of debt in China, like this isn't some little emerging market pissant country that has a 10-year boom and then things fall apart. China has become so large that it's literally unprecedented, the issue that we're dealing with here. So just to put some numbers around that, 10 years ago, when everyone was worried about Chinese debt getting out of control, the total debt to GDP in China was something like 120%. Since then, it's gone up by more than 100 percentage points. So just to put that in absolute terms, China is technically the second largest economy in the world. We're talking about 25 to $30 trillion of debt. And so that's the scale of the issue. The kind of fundamental problem here is that after 2008, China continued pushing on the gas pedal of its economic model, which is based around investment. Like everyone thinks about China as this export powerhouse, and they are, but really the economic model is the same as the Soviet Union's model, which was seize savings from households, direct that into investment to catch up with the West, catch up growth, invest in highways, invest in factories, invest in railroads. This is what that model excels at. And for a very long time, that was great for China because every bridge, every railroad that they would build was very productivity enhancing. The problem was like somewhere around the mid 2000s, it stopped being productive to build the next railway, to build the next bridge, to build the next apartment building. because you weren't getting the productivity boost out of those things to justify taking on the debt to build them. And the way that you can see this is when debt to GDP goes up, 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 that means for every dollar of debt you're putting into the economy, you're not generating the GDP to pay it off. So that's the one metric that you can look at to see the inefficiency of the investment that's going on. So this is nothing new, and the Chinese have understood this for a very long time, going back to like 2007, 2008. And at that time, they were saying, hey, we got to change the system. This is going to end badly. And in every previous case when this has happened, the Soviet Union, Brazil in the 1970s, it's always ended badly. So they recognize this for a very long time. They've seen, hey, we have to transition to more consumption. We have to transition our model to something different. And the problem is that that's extremely hard to do without incurring big time pain in the short term. If you hold it off and continue and persist down the same route, then the pain gets bigger, but you're pushing it off slightly farther into the future, which all else equal is always the choice that people will follow. So getting to what you're saying about Evergrande in 2017-18 and sort of what's a little bit different is that they've accelerated their attempts to make change, to step in and say, hey, we're not going to provide just an unlimited guarantee, an unlimited backstop to everything. We're going to allow certain actors in the economy to default. You need to think about this in terms of efficiency and productivity, and you can't just lend money to anyone without thinking about, is it a good thing to build? Is it a good thing to invest in? Do you have any?
Yeah,
I'm just going on and on. This is a long story, so feel free to.
Well, no, but that sort of brings us.
Rabbit holes there.
Well, no, maybe. I mean, but so bring us down to this moment, which is why does that matter for? I mean, that matters sort of in the grand scope of things, but like China can deal with debt. It's been dealing with debt for a long time, and just I was feeling very, very pessimistic about the yesterday. I'm actually feeling a little more optimistic today because here, just after a brief search of some headlines from the past this morning. Will China's real estate bubble burst? CNN Business, 2012. China's real estate bubble about to burst. The Diplomat, 2014. How big is China's real estate bubble and why hasn't it burst yet? Some academic article with 5 different names that I'm not even going to pretend to pronounce. Peak China housing, 2020. National Bureau of Economic Research. I mean, people have been calling this shot for quite a long time. And you have had previous periods where Chinese house prices go down. If you look at a chart, it happens in 2012. It happens in 2014. You even get a little tiny dip in 2017, and then we have a pretty sizable drop in this year. Still not quite as stark yet as what happened in 2012, but starting to get around sort of that era. So in some ways, I'm a little chastened because, as you said, this has been happening and people have been calling for this over and over and over, and it hasn't been the moment. But I think the thing that has us a little bit more concerned is that this time it's coming with individual Chinese people saying, I don't want to pay my mortgage. I don't trust that this money is going anywhere, or that I'm going to get anything, or that this property is going to be completed. I also, there was a chart that will be in the Global Sit Rep. If you haven't signed up for the Global Sit Rep, listeners, here's the beautifully natural plug that I just made for it, where the ratio of housing starts to completion since 2019, basically everything is getting completed in the coast. The places where things are not getting completed are the interior. It's the middle of China. It's the third tier cities. If you even go into the data and look sort of more granularly at sort of first tier, second tier cities, prices are actually going up in some of those areas. It's really in those third tier cities that things have gotten bad. And maybe you could just, I think this is a good point to tell the listeners what you told me yesterday, which is now we're going from liquidity problems, which the Chinese government can handle liquidity and debt. They're experts at that, to, is this a crisis of confidence in the individual Chinese person who is used to putting their money in real estate and now suddenly is finding, that wasn't such a good bet. And not only that, I maybe can't get my money out. That seems to me to be the thing that is scaring us, and it's not exactly clear. But maybe drill in on why that lack of confidence is the thing that maybe not even the mighty Chinese Communist Party can handle.
Well, that's the thing. And it's funny that you bring up these articles from 2012 and 2014 because that's what a bubble is. Every bubble has challenges early in the bubble that reinforce the belief in the bubble and causes it to surge to new highs. Look at Bitcoin, for example. In December of 2017, Bitcoin prices dropped by 50%. And a lot of people were saying, oh, it's over. And what happened was all the people who felt left out of that Bitcoin, phenomenon decided, oh, here's finally my opportunity to buy this Bitcoin thing. And, Bitcoin ended up going up by 5 times more before rolling over again more recently. But that's the nature of bubbles. They have tests that they must pass in order to move to the next stage. And the thing about the treadmill to hell is that the longer you're on the treadmill, the more precarious it becomes because you're on a timeline. The difference between now and 2012 is the scale of the problem is an order of magnitude larger, and the scale of the leverage is an order of magnitude larger. And if you look at someone like Hyman Minsky, this is a wonderful example of theory actually in practice, because Hyman Minsky famously talked about Ponzi finance. And what Ponzi finance means, what he was talking about was this psychological transition as you progress through a bubble period where successfully passing those tests makes you more confident and more risk-taking. And you enter the stage of true Ponzi finance, which is you're borrowing money and you're counting on the appreciation of the asset just to pay off the debt carrying costs. And that's what gets to this mortgage thing, and partly why it's so interesting. Because people are taking out mortgages, just to be clear, to purchase homes that have not yet been constructed. Like, the issue here is these guys are concerned that they're not going to even finish the damn thing, and they're already paying the debt to own this unfinished, pile of bricks. That's an interesting change, and it shows how financially extended some of these people are and how dependent they are on the notion that prices or price appreciation is going to cover their financing costs. So that's a sign that things are fairly precarious. But I just want to talk about the notion of credibility too. And you spoke about the issue of confidence. And this, I think, is the most important question. And when you ask me, like, okay, what is the one thing that we need to focus on? I said, well, you need to tell me, are the Chinese going to lose confidence that property prices will keep going up? Which is kind of an impossible thing to answer. And I think we'll have to dig into it. But that's the number one most important thing here, because without that confidence, then you get that self-reinforcing bubble deflation. Because if people don't expect prices to go up anymore, they're going to start selling. And the selling is going to cause the prices to go down. And that's going to feed back into expectations, which is going to cause more selling. In previous examples where this has happened, the government has been able to restart that bubble process by using sort of these broad brush tools that they have at their disposal. So they can lower the amount of a down payment that you have to put down for your mortgage. They can use other sort of policy tools to encourage property investment, all those sorts of things. And they're clearly starting to do that to some extent now. And maybe that will work. And that's the key question. But there's a persistent belief, I think, which is very dangerous, that the government can control asset prices. And I think this is one of the big blind spots among even very sophisticated professional investors. Because when we talk about, oh, well, the state, they're not going to let this happen until the party Congress later this year. Like, they're not going to allow property prices to go down. And I think that's way too sanguine. And when we talk about the Chinese state being able to prevent a crisis, or like, you don't have financial crises, like why haven't we had a Lehman style moment in China? That confuses the state's ability to be a lender of last resort and provide unlimited liquidity on the liability side of the balance sheet. And it's confusing that with their ability to influence the asset side of the balance sheet, which is
Yeah.
way beyond their power.
Yeah. Well, you said on the thing about it being an impossible question to answer. My father, who was a professor, recently retired, always had something on his desk when students would come in for office hours that I always remember. I need to steal it. It's a sheet of paper, and it says answers 25 cents, answers parentheses requiring thought $1, answers parentheses correct $10, and then dumb looks are still free. So I don't know if I'll get you the correct answers, or the $10 answers, but I've got a lot of 25-cent and $1 answers and tons of dumb looks for you. But in all seriousness, I wonder though. So I'm trying to dig into the bullish thing here and think if China actually does have the tools to do this. And when we were talking yesterday, I was a little. I had less command over what the Ponzi element of this real estate thing was, but I think it's exactly that. So there's two sides of this. There's the individuals who are buying the property, even if it's not completed, because they think that's a way to store wealth. And then there's the developers. And the developers are taking the money from the buyer and using that to finance future construction of things and then selling more things so that they can build more things. And that's where the Ponzi loop kind of goes together. And I think that maybe what the Chinese government is thinking or trying that it wants to do, and this is the answer to your question, or not the answer to your question, but to your point about asset prices. I think China wants asset prices not to collapse, maybe not even to go down, but Xi Jinping's whole thing since he came into power was L-shaped growth, that China was going to go through a period of L-shaped growth. And that means you go down for a while and then you go neutral for a while you do all the things that you have to do to reset the system. So there is a bubble in the system. And I think when you look at the types of stimulus China's trying to roll out right now, what they're trying to do is, I think, because there is this confidence issue brewing, they're trying to say, okay, developers, like this round of stuff, you got us. We're going to bail you out for these things because this is creating a problem that we can't control. We need to make sure that asset prices don't go down for these people who bought these houses. But going forward, that's not going to work. And we need to be in a new world once we get through this crisis. So not only is there going to be no more Ponzi scheme, that real estate tax issue that we said we were going to pilot this year and we took off because we're worried about causing more lack of certainty, that's coming back on the table here. I wonder also, I mean, this is a country that ordered its people to have one child for over 30 to 40 years. Why can't they order people to have one house? This is also, people who own property in China don't technically own the property themselves. They get rights to it for a period of time. The Chinese government technically owns everything. Does the Chinese government take it back? If there are properties out there that don't have any buyers, does the Chinese government come in as the buyer of last resort and say, okay, like we will nip this one in the bud in the understanding that this is not how this is going to go going forward. And in the meantime, we want to see investment in those other productive sectors. We want to see the stock market go up. We want to see investment in companies. We want to get away from this investment in real estate. One of the things that made me think along these lines was Michael Pettis, who, if you care about China at all, you should be reading Michael Pettis. He had a statistic in one of his pieces from April talking about the Evergrande issue, where he said something like 1/4 to 1/5 of all of China's housing stock is empty. There's nobody living in it. And so, I mean, that's actually kind of, I mean, that's terrible. That's an example of a bubble and really badly and inefficiently allocated capital. But China's problem is that you have hundreds of millions of people who haven't gotten to enjoy the wealth program. And what Xi has to do is redistribute wealth on a massive scale without cutting the knees out from underneath him. So why not take all these empty places in these cities that everybody wants to live in and give them to people, or create housing for these people who don't have housing right now? I mean, there's a lot of things you have to do to get there, but the reason I'm more optimistic this morning than I was yesterday is that I think maybe they have more levers to do this in a way that makes some sense. But to your point, if we're thinking about it from an investment perspective, like, there still has to be some pain at some point, and somebody's going to have to foot the bill. And I'm rambling a little bit, but the last thing I'll say, and this is the thing that still really bothers me, is that the FT had a quote from a Chinese banker this morning, and China's telling the banks, bail out the developers, give them the loans. We're going to give you incentives and tax credits and lower, but do it. And the quote, and who knows if the FT actually has somebody who's real or if it's just somebody who doesn't know what they're talking about. But the quote is, "We are not going to touch these projects, even if it is politically correct to do so." And if the banks aren't going to do it, and they're saying, screw you to the Chinese Communist Party, we told these property developers what was going on. Like, why do we have to be the ones to bear the brunt of this? Then we're in a world where it doesn't actually have control over the levers, and we're beyond confidence at that point. They don't have control. So that was a little bit rambly, but tell me if I'm crazy, or if you're feeling a little better after that thought experiment.
Well, I'm not feeling better, and here's why. A few things on the subject of controlling property prices and keeping them stable but not going up. Mm-hmm. The nature of a bubble is that there is no stable. Bubbles are dynamic, complex systems, and they require, this is the thing that's so tricky to wrap your head around with bubbles, is if they don't accelerate, they die. There is no stable in a bubble. That's not the dynamic of how they work. And like, the accounting behind that is, like I described, people are taking out mortgages that they cannot afford with the expectation that the appreciation of the asset is going to pay off the mortgage. And that's a big part of why people are coming and saying, hey, screw you, we're not going to pay these mortgages, because the implied guarantee you gave us that property prices will only go up, we don't have the confidence that you're holding up your end of the bargain. That's a big thing. So there is no stable, there is accelerate or there is, implosion, I think is one thing. The other thing to think about is go back to 2015 in the stock market in China. So at that time, if you remember, there was a huge stock market bubble. And early in the year, the word started going out that, hey, the government wants to really increase the value of the Shanghai, index, the Shanghai market. And it's green light that they want prices to go up. And part of this was they were trying to move the focus away from property. This is all part of their attempts to kind of release some of the pressure from this system. And for lack of a better term, it was a fucking disaster. because they unwittingly unleashed a much bigger and faster bubble than they ever expected. And then when they tried to step in and sort of do as we just described, hey, let's just have prices go flat a while, the whole thing collapsed. And then when they tried to order all the brokerage houses to buy up stocks to support it, the floor fell out and they couldn't do it. So that's the stock market. The stock market is a tiny, tiny fraction of the total value of Chinese property. Chinese property is like Jupiter, and the Chinese stock market is like, our moon. So I think there's an overconfidence, which, I don't know the Chinese bureaucrat, but it's not hard to believe that they would be overconfident about the ability to control market forces, right? And you have a track record of them failing to do this. So that makes me not very optimistic about their ability to engineer some kind of soft landing in prices, or just like a long plateau period. It's too big of a market. The dynamic doesn't work that way, and they have shown in the past that they can't do it. The other thing that just getting to what you said, which is really what caused the alarm bells to ring. And it's when I read this story about the depositors in, what was it, Hainan Bank?
Yeah,
I forget
and on.
the
Yeah.
name, Hainan Bank. And like, I haven't paid attention to this issue for years. Like, we've been doing our thing, oh, US, Europe. This is the biggest story in the world. And it's just so slow moving that we just kind of put it on the shelf for a long time. But now it was that story that caused me to really say, holy shit, now it's time to dust this off the shelf, because this could be the moment. And the reason, just to get to this issue about lack of confidence, is and Logan Wright of Rhodium Group has talked about this in the past in a way that I think is very well done, where he talks about credibility as the underlying asset in the system.
Mm-hmm.
And the whole Chinese system and the Japanese system in the 1980s was exactly the same way. It was all based on the credibility of the state to step behind and make sure that no one ever defaults. The only thing that matters is this person politically protected, or are they a pariah? And as long as they're not a political pariah, then you can lend or invest and build whatever, and you're not going to lose your money. And that credibility is what the government, ironically, is trying to dismantle, because they realize you need to have market-based pricing. You need to have real, evaluation of the risks of something. Otherwise, the treadmill to hell is just going to blow up. And when you talk about the difference between 2014 and today, what's happened in the interim is that they've made really substantial moves to dismantle that. And the Evergrande is part of that. But the reason why I got freaked out reading about these bank depositors who, the local government sent in the thugs to beat them, and they activated their COVID red alert thing on their phone, so they couldn't move around. And it's a terrible and very intriguing story if you read about it. But the issue was that these were bank depositors who, it looks like they didn't even have bank deposits per se. It looks like they had bought some kind of wealth management product, which was pitched to them like it was a deposit, because it was, oh, hey, this is zero risk. So they weren't covered by the deposit insurance scheme. Should I explain some of this lingo, or should we just leave it?
No, I think
I
you're
don't
good.
know.
So, no, you haven't said anything so far. I think is beyond
Okay.
the listeners. And of
So,
course, listeners, if you disagree with that, feel free to write in and tell me. And this will not be the first time we talk about China, but I think you're good.
yeah, knowing the exact definitions of these terms is not that important to understanding the point of the story. The point of the story is that these people started queuing up because they saw, in this case, it was a particularly egregious example of this local bank was being used as essentially a financing conduit for, corrupt local political groups that were, lining their own pockets and basically building a bunch of white elephant crap and the usual kind of corruption that's just part and parcel of local government in China. But these people didn't have the confidence that they were going to get paid back. And they didn't have the confidence that this local government financing vehicle or this bank was ultimately going to be able to provide them with their money back. And that's a huge problem. And it gets to the issue of credibility. And I don't know what it is. And this is why I say I think this is the number one question. And I don't know if it's the COVID lockdowns or if it's just what the government has been signaling about, we're going to let certain groups begin to default. But that's a big change from what you've seen before. Like, it's no longer the assumption that everyone's going to get paid back no matter what. And that is monumental.
Yeah, and I think this is the struggle, which is because my impression after reading about it all week, and I mean, there's a limited amount we're able to do even with the statistics and things that we have at our disposal. We're having to infer a lot, But it seems to me that the two goals for the Chinese Communist Party are, number one, to make it clear to the individuals, you will get paid back. You are not in danger. Like, we will take care of you. But then on the second level, to stop the treadmill or to pop the bubble. And to your point, maybe that's not possible. Maybe that's not how bubbles work. But maybe I'll throw the metaphor back at you. Like a treadmill, you can slow a treadmill down and still keep it moving. A bubble, like what? Let's get even philosophical. Is a bubble just like, a bubble that you blow with a kid via a toy? When you pop it, there's no bubble there? Or is it sort of a growth that shouldn't be there, and when you pop it, there's still an underlying trend line that is going up? And can the Chinese government be arrogant enough to think, okay, we can pop this bubble and take care of these people and these problems, but the trend line is still good? Like, we still have growing population and all these other things. Like, if we could just get away from the Ponzi scheme model and compensate people who are involved in the Ponzi scheme model. Real estate, it's not like we need to stop real estate overnight. We actually need real estate to be productive, so we can tax real estate and redistribute wealth and do all these other things that we want to do. I mean, maybe that's completely fanciful, but I guess maybe that's why we're so nervous, because that's sort of what they have to do for this to end well. And I don't know how to. I don't think any country's ever done that. Can you think of a country that's done those two things at the same time?
Well, maybe that would have been possible 15 years ago, but I don't think it's possible today. So the total value of real estate in China is almost 2.5 times the total value of real estate in the United States. And of course, there's a population issue there. But if you look at any sort of normal, and real estate in the United States is overvalued.
Yeah.
But most like normal analyses would say that the total value of real estate in China should be like 2/3 of the value in the United States. So you're talking that it's something like 75% overvalued.
Yeah.
If you look at the Japan case, the value of real estate in Tokyo went down by 95% over a very long time period. But it was, that's an enormous magnitude. And so you have a valuation problem. Like, the size of the bubble has become like you're way beyond fundamentals right now. Mm-hmm. And then the fundamentals aren't very good. I think that's part of the problem. Like, China's working age population peaked like 4 or 5 years ago already. The urbanization process has largely run its course. The amount of like space per household is already like easily at developed market levels. So there's about the same amount of square footage per person in China as there is in the UK or France, which, when you think about, income per capita and productivity, like, there's just way too much stuff. So I don't think that's a plausible outcome, and we've never seen that before. But I do want to get to something you said earlier, which, when we had this conversation yesterday, I think what I left you with was, well, you need to think about, you're the political guy. You need to think about what's going to happen here. Because I think what you said about, seizing these assets and redistributing them, and it's not just seizing it from, wealthy individuals and redistributing it to less wealthy individuals. The bigger issue is that the local government sector of China's economy is just way too big. And that's where all the people are getting rich. Politically connected real estate development and ownership of assets and state-owned enterprises and things like that. The only real solution, I think you're right, is to seize those assets and redistribute them. Like, that's the best case scenario. But politically, like, that's a bloodbath. Like, this is a question for you. I should just shut up because I'm curious to hear what you think. Like, can she do that? The vested interests that are up against him, are they strong enough to resist that?
I mean, he's preparing to do something like that. I mean, this is the point where we have to leave our ideology behind. Like, I I don't. There are dictators out there who are just megalomaniacs who want to be dictators for the sake of being dictators and prey on popular. Like there is a class of leader that is like that. And maybe I'm wrong, and maybe I'm naive about Xi Jinping. Everything I know about Xi Jinping tells me that's not him. Tells me that he's an outgrowth of the Chinese Communist Party, an outgrowth of that system. That he is a relatively smart and capable steward of Chinese governance. He's been ahead of a lot of different things and has pulled a lot of the right levers and has said and done a lot of the right things. I don't think he wants to be a dictator for the sake of being a dictator. His family, like, personally suffered from Chairman Mao being a particularly crazy version of the type of dictator that we're talking about. That said, the only reason to eliminate the possibility of somebody succeeding you and throwing all of your rivals in jail and making it clear that there's a new sheriff in town is you're going to want to do something where you can't broke opposition, where you need to say things, and people like that banker that I quoted do exactly what you say, either because they feel it's in their patriotic interest of the country or because they're afraid that they're going to get their head chopped off if they don't. I think he doesn't want to do the head chopping off thing. He doesn't want another cultural revolution. He doesn't want to do this the way Mao did. The way Mao did it was pure chaos. He just imposed chaos whenever he needed to make a major change and somehow sort of found the path through it. That's not what Xi wants to do. But I mean, that's why I would say Xi is stacking the deck for his leadership. And maybe this is I don't know if this is the end goal. I think a lot of people would say, oh, he's doing that because he wants to invade Taiwan. I think it's more, no, I think he wants to take on the Chinese economy and be sort of like Deng Xiaoping and say, okay, we have to do these things if we're going to get to this glorious future and this dream of natural rejuvenation that I have. And the only way I can do that is to be emperor. So make me emperor now. And it's going to suck for a while, but also Chinese Communist Party, I will in some ways protect you because everything will be in me. It'll be a charismatic dictatorship. All the blame will fall with me, but also all the credit falls with me. So when things go bad, there's a lightning rod. It doesn't go to the entire system. I think maybe that's part of the thought process. So if you're being generous with Xi as a leader and thinking of him as a leader of that class, then yes. And I mean, like you said, if we're being very apolitical and non-emotional about it, like even The Economist would say this, or any Western source. I mean, Xi just needs to redistribute wealth. There's a huge imbalance between the coast and the interior. He has to somehow create markets that work well, but also fix all of the inequalities that popped up over the last 30 years at the same time. That's a neat magic trick, and it's probably going to take everybody doing exactly what you say. If it's even possible. Maybe it's not even possible, and maybe I'm being totally naive, and maybe he wants to be emperor, and maybe he's got tons of assets that I don't know about, and he's doing fine. I mean, that's not my impression of him based on what I know about him. But we are, and this is also some level where geopolitics starts to break down. I mean, geopolitics tells us exactly what China needs to do. It does not tell us what Xi is planning to do tomorrow in order to achieve those things. It tells us something about whether China has the requisite political resilience to do that. To your point, like, yes, there are entrenched political interests, but if there's a bigger political actor that eats those interests for breakfast and throws anybody else who doesn't go along with the rest of the government in jail, okay, well, those interests will go away. I imagine that's the sort of thing that Xi is trying to do, but there are counter arguments littered throughout there. I've had to make a lot of assumptions to get there.
I guess that's what worries me the most. And, people talk about black swans, which I hate that term because everyone uses it in the wrong way. Like, they talk about tail risks as black swans, like low probability outcomes that we know about, that we can identify. Like, oh, a hurricane is no, a hurricane is not a black swan. Everyone knows about hurricanes. Like, in this case, I worry about a true black swan in what I mean is like an unknown, because if indeed the bubble is popping, and it does pop, which isn't a given, maybe it's 2014 again, and we're going to put this back on the shelf, and we'll be back here in 2025, and I'll have even more, gray hairs in my beard that we can make fun of. But if it is indeed happening, then, like, I think it's very unpredictable what could happen, because you're going to need to see some sort of very violent seizure and transition of wealth, I think, is the ultimate outcome of what's going to happen. And what that could lead to, I really don't know politically. I think it's a huge question mark in the first place. And the second place is, if the bubble does indeed pop, like, let's just think, if you're an investor, like, what does that even mean? Well, today, China accounts for something between 40 to 50% of all demand for industrial commodities like copper, iron ore, things like that. That's going to be severely curtailed. So you're talking about commodity prices and places that sell commodities like Brazil in a world of hurt, first of all. So that's one outcome. And then the second outcome is, within China itself, 13% of the economy is tied directly to property development, which in a normal economy like the US, it's like 4 to 5%. So you're talking about, more than double, almost triple what a normal rate would be. So that's 13% of the economy that just is severely, just mostly goes away. Doesn't go away, but a lot of that is going to go into reverse. By some estimates, the broader property sector, with all the like ancillary jobs attached to it, is more than 20% of the economy, which is just crazy huge. So you have a growth issue just at the very high level. The other kind of outcome that people don't talk about as much is local governments are dependent on property to function. And I don't mean like the incomes from property. I mean taking land, developing and building and selling, new properties as a source of their income. And that's about 40% of local government revenues, is developing and selling property from land that they seize. If that goes away, that's a major problem from a financial standpoint. Like, their incomes are going to be crushed. Mm-hmm. And that would be less of an issue if they didn't have massive debts through these local government financing vehicles, these sort of trust entities that have been set up to finance these governments and finance the projects behind them. And the people who finance those are ordinary Chinese savers. So you have a sudden stop kind of problem on your hands there. But getting back to the political thing, and I think the unknowns, the black swan issue is, and you can speak to this probably better than I can, so much of the underpinnings of the Chinese state's credibility is about moving forward, creating a better life, constantly progressing. And their rhetoric is all about this. It's all kind of couched in this Marxist rhetoric of, okay, now we're in the stage of socialist early development, and now we're going to the stage of socialist, middle development. And it's all about, the belief that tomorrow's going to be better than today. We have the credibility because we're delivering the goods. And if you look, even in other countries like the United States, which I think has a similar mentality, there's a really great book by a guy named Benjamin Friedman from Harvard University. And he's looked at historical periods in the United States where growth just slowed down. Like, people's incomes slowed down. And he looked not only at sort of political volatility, but also just like social factors of like, suicide rates, disease, violence, crime, all of these things. And when you go into those periods, all of these things become worse, mm-hmm. because there's sort of this betrayal. And I just wonder, what sort of risks do you take in the Chinese context? Because they've literally never dealt with that for generations now. And I don't know, but it's, generally speaking, when systems are growing and the political questions are about how do you distribute the goodies, that's a whole lot easier than how do you distribute the pain. And that's when the bad stuff emerges. So,
Well, yeah, and to your point, I mean the Chinese government and Xi Jinping. I mean, at first he was going to make the real estate developers take it on the chin. No, like they're talking about a 5% GDP growth target. They've rolled out what 200, I forget what the number is total of the types of packages that they've rolled out just this week is something like $200 billion in total to support the real estate sector. They are not behaving. They push back the real estate tax thing, so they were going to pilot it in like 10 or 15 cities this year. They took that off. They said, okay, fine, like we're not going to do it. They've lowered the mortgage rates. They're doing all the things. They are not behaving like a government that is ready to dispense any pain. They're behaving like a government that says we're not ready for this genie to come out of the bottle. Let's put this genie back in the bottle for a while and fight this fight another day. Which, to your point, means that the treadmill could go on for a little bit longer, or we reach this sort of disjunctive moment. And I guess another thing I would say is that, that thing about the bank depositors in Henan, really important, but you would think if if this was a systemic issue and it was everywhere, that we'd be seeing it everywhere. Like we would be seeing lots more protests and lots more problems. And if all we have is one bank and one group of depositors in a country of over 1 billion people where real estate is this bad, like we should be seeing a lot more. Like China can't control, it's too big to control the kinds of things that we're talking about, or to control those types of events. It is not a black box in the way that a place like North Korea is. It has black box elements, but it's not. So in some ways, like we should be seeing a lot more if we are reaching to that tipping point. So, maybe not. Maybe the confidence does begin to decline. Maybe 2 to 3 more months of falling real estate prices we'll get more people coming out into the streets and being concerned and things like that. But our abstract hypotheticals, the political scenario, the Chinese government is blinking. It's saying, fine, like we'll keep the treadmill going. Like let's hit the button. So,
which is why I think this is such a crucial moment. Is like that's clearly what the markets are reading. Like Chinese assets, like the equities of these developers have jumped, and the junk bond prices in China have jumped because everyone's saying, "Oh, okay, they're giving in," which is what they've done every other time. It's like the yo-yo policy. We talk about like analyzing China is like analyzing a yo-yo, where they're going to get a little discipline. It's like Saint Augustine, like make me good, but my God, not quite yet. And I guess the issue is, frankly, I hope that that's the case, and we're going to put this back on the shelf and go talk about the Fed and deal with all the other million things that we're looking at. But I do think this is the number one thing to focus on right now and to watch, because you said the term "put the genie back in the bottle." If the genie's already out of the bottle in terms of property prices, this is the big, like, forget about the Fed, forget about the Russia war. Like, this is the number one thing to focus on in the world, and very few people give a shit right now.
Yeah. Do you think it's, and we're starting to get over time, but I'll say one more, or ask you one more thing, which is that you sort of alluded to this about global commodity prices and copper and iron and things like that. And I saw Goldman Sachs came out this week and revised down their projections on iron ore prices because of the real estate problems. Is it fair to say that the whole world is in on the Ponzi scheme? That this really isn't just China, and that China has been such a huge source for steel, food commodities, energy commodities. When you talk about the commodity super cycle narrative, a lot of it, which in itself sort of sounds Ponzi-ish, right? Like commodities are just going to keep going up in price because we're going to keep using more and more of them. A lot of that is because China's, consumed more steel in the last 10 years than like most of the rest of the world did in the 100 years previous. I forget what the exact stat is, but it's some like wild statistic like that. So in some ways, doesn't the world sort of needs China to stay on the treadmill? Like people will throw a lot of shade at China and they'll talk about the bubble collapsing. But for the bubble to collapse, like it really would, I think, take the bottom out from underneath, not just Chinese real estate and the Chinese government, but it would reverberate in commodity prices throughout the world, I would think, in ways that would be really destructive. Am I being too sensationalist there? Or is that the reason that you're saying this is the most important thing to think about?
I don't think you're being too sensationalist. I think you can paint a more optimistic scenario. Like, people thought the same thing about Japan in the 1980s. At that time, everyone was obsessed with Japan, 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 Japan. And they were the number 2 economy in the world, and they were soon to overtake the US. And when the bubble burst, it was viewed as like, oh my God, it's the end of the world. And of course, it wasn't, because other areas rose up and people kind of ignored Japan and forgot about it after 10 years or so. Like, that's the good scenario. Like, China is not the whole world. And, demand from developed markets, like you look at a place like Europe, which has not invested very heavily for years and years. And this is a theme that we've talked about a lot. And, sort of the acceleration of investment in Europe, kind of the recognition of these strategic priorities that they need to move toward, and those sorts of things. That has the capability of offsetting a lot of this. So that's the optimistic view, is like, the world is not going to come to an end if other areas do indeed step up. The more pessimistic view is, this has been the regime of the last 20 years. This has been the world that we live in. Since China entered the WTO essentially in 2001 and started to accelerate their growth, accelerate their fixed asset investment model, that's when the treadmill to hell really started. And anytime that you go from one regime to another one, it's always disruptive and problematic. And, if indeed China has like significant problems, and you do have an asset bubble burst in China, and the property market has a sustained and significant downturn, like, there's no way around it. That's bad. That's bad for the world, and it's going to introduce volatility and problems that many of which we aren't even thinking about. And I don't mean to be too dire. And again, maybe this is totally a false alarm, but we're focused on this. I don't know.
Yeah, no, because to your point, I mean, treadmill is almost not a good metaphor, because you can get off a treadmill. That you need something in the metaphor, that it has to be some sort of conveyor belt that you can't get off of.
Really, I always find it hard to get off a treadmill, because
yeah, it's hard, but it's not impossible. Like, you can jump off. There's a stop. You can hit the stop emergency button. Like, there are ways to do it, but like,
yeah, but it's never pretty.
No, it's never pretty, but it can happen. But we're talking about sort of an inevitable doom. Anyway, so we hope you enjoyed all of that really rosy, optimistic talk. For the record, this is a very foxy conversation. I always go back to the Philip Tetlock, Foxes and Hedgehogs. Rob and I'll speak for Rob here, and he'll tell me if I'm wrong, but I think I can speak for him here. Like, we're both foxes. So, I mean, if you're a subscriber to the Sit Rep this week, the In Focus piece will be a tortured whirlwind through my brain of the 3 different ways I think Rob is right, and the 3 different ways I think I've countered him, and it's just going to be like a lot of kind of all over the place. That there is no definitive answer here. If we had a definitive answer, we wouldn't even tell you, probably, because it would be kind of that momentous. So, in that spirit, we're talking to try and figure this out. And if any of you want to talk about it or have insights, feel free to email in with us. So I don't think we'll leave this topic at all. We'll probably come back to it. But we've given the listeners 70 minutes, Rob. So I think they'll have their fill. So we'll say goodbye there, and hope you encountered a particularly long traffic jam on your drive wherever you're listening to this, so that you got to get through the whole thing. And cheers. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.